Turnaround Wednesday. How's everyone doing? Zig, my buddy, William Carlson, Victor, Yassine, how are you? Everyone doing okay? Steve Walsh, Sean Murray, Sophia, how are you? Ping pong over the net. Hello, Mohammed and Mark, everybody. Okay. Hi, guys. All right, so the trapdoor under 2800 has been released, and to me, this is really the bull's last stand here around 2780, 2770 of the moving average here on the daily in S&Ps, and I think the weekly is right around the same area. Yeah, here's your 50 week coming in right there at 277677, so we're right around that area. Really short term, not much divergence happening here. I mean, I guess you could call it, if you wanted to look for a bullish reason, perhaps a 3 is developing here. I really think the key is going to be, if we get any kind of rally on turnaround Wednesday, it's going to come from this. So last week caught the dollar here, covered a little early in the 70s, talked about a retracement this weekend in the dollar. We almost went to 61.8 right here. So this is a very interesting area for the market to fail. I think there's a good chance of it. I have to believe a reversal that we had here until it's not there. And you could say, okay, you know, we're going to 98.80, 99.20, and that's possible if we start exceeding all of these areas up here, the retracements, especially 78.19. Once you start surpassing 78.6, then the percentages of this being, you know, any kind of peak is reduced. But to me, it looks like this is going to be the magnet, this line down here, which is going to take you around 96.70 to 80. There you go, down here. So this is what I'm looking for. This could save the market for a while, but the market looks really terrible. Okay, I mean, you look at the S&Ps on a weekly or a monthly, and you know, if this isn't a 3 drive, I don't know. I've never seen one. Shows up on the weekly pretty good. Right, 1, 2, 3 megabone top. You know, if we don't hold here, there were some bulls saying we'd get one more run to 3,000. If they're going to be right, we need to hold that. But look at the glaring divergence on the through the telescope. It's pretty good on the weekly, right? Look at the monthly. Okay, here's our peak in 17. Here's the RSI. Last year, and on this recent high, look at this glaring divergence, way under 70. So, you know, some internal momentum divergences showing cracks, a pretty ugly month. We're almost done on the month. The 2-month off number is 28.35, so we're 50 handles under that. So we'll see what happens with that. And, you know, the other thing was yesterday, I didn't stay with it, but I bought some gold yesterday. I should have stayed with it at 78. Okay, so you check this out. Another perfect 61.8. I got out on this bounce thinking there might be a 3 drive, but here we are challenging it. And gold's going to get, if we, you know, really start to accelerate to the downside, you look at this formation right here. If we get through 1287, with the low being 1270, you just tack 17 on there, it could get you back to 1300 on a break of 1287. Silver acting weaker, but that too in the buy zone here. Here's your falling wedge. Pretty unusual to have 2 throwovers. So we had one, then back in the wedge, couldn't break out. Steve was showing this formation. Now we're back underneath it again. I wouldn't be short silver here. That's all I could say. I know that the gold silver ratio, which is something else that, hey, Steve, I found how to get a gold silver ratio chart. You know, it was right there at my fingertips. So here it is. Making new highs yesterday, but diverging. That's your daily. Here's your monthly. This is going to be a very important area. In fact, this is, I believe, as far back as it goes here anyway, back to the '08 crisis, the Great Recession. Everyone remember the Great Recession? Was it great for you? For anyone? Were you short housing? For some people, it was great. Okay, so the gold-silver ratio approaching these highs. Still no divergence, which says still favor gold over silver. But I think we're getting closer. So, I'm starting to stalk this. And it looks like you could actually trade this as a CFD. I don't know. I'll ask Steve because it's on Oanda real time. So usually if they're showing something like this, you can actually trade it. So keeping an eye on this, but silver much weaker. Still, yesterday it really got hammered compared to the gold. I just wanted to show you the gold-silver ratio there. And then, a lot of talk about the bonds here. Something that we talked about together here on Phase, and I have these lines drawn on the 10-year, which, we're almost there. Some people talking about should take out the line around. Some people looking for 216. I have the line coming in right here, 220. I don't have any short-term momentum divergences yet. See, still confirming the lows. And I read Welsh's piece yesterday, and Jim's thinking this bond rally runs into June and has some targets on TLT around 132, 133. And then, that this is just a big ABC. Maybe when Greg is here, we could talk about the interest rate, and maybe even Steve, that this whole thing is an ABC. And when we top, there's actually potential for us to revisit the highs from last year in yields, and TLT falling to 105 is what I read. So something that's setting up that I'm looking at. I haven't committed to it yet. I'm always early. Going to try and let the market tell me. What's interesting is the 30-year has a throwover already. Okay. So what I do with throwovers, just like silver, is, let it do its thing down here. Wait for it to get back inside of the wedge, inside the formation, then go with it, looking for a breakout. And what's the rule for wedge retracements? Anyone there know? 38%, 50, 61.8. Oh, it doesn't. That's right. Hey, look at these people here. We have some technical analysts in the house here today. I only say that because I interviewed a guy who was technically anal. Okay, so anyway, congratulations on knowing that. So look for wedges, because look at the potential wedges offer if and when you catch a reversal on it. And, we show a lot of them in here in Face. The guys, sometimes wedges will just start popping up everywhere, and even somewhat unrelated instruments. It's kind of like the rhythm of what's going on in the market. So that's your mentoring session for today. The only thing I'm really doing right here is playing the retracement in the Dixie, and I've kind of slowed down a little bit this week, but you know what? I'm going low alpha in this environment right here, where I could end up having size on. So a little yesterday, a little today. We'll see how the dollar finishes. We'll see if S&Ps can hold their moving averages, and crude keeps on giving to the downside. This time we may have a little momentum divergence on the 4-hour. This looked like a flag. I can't get long the crude for a reaction yet. That doesn't look too bad. Maybe a little stop hunt here. But my preferred turnaround Tuesday candidate is something that already showed its hand last week. We'll see if we could turn it. Any questions for me before I turn it over to the boss? I'm not talking Bruce Springsteen.
You might be
Okay.
talking some Bruce Springsteen.
Huh? You like him?
Yeah. Oh, of course. Who doesn't like the boss?
It's weird, Blake. I know a lot of people that don't. I shake my head. How can you not like the guy? But
Really?
yeah, yeah.
No, when I was in New York, this Christmas, he was doing a live show, and we didn't know. We were walking. Oh, I'm sorry. It was last summer. Now that I
Joe
think
just Skype Born to Run.
well, yeah,
Now I walk at a fast pace. I don't run anymore, Joe.
we were walking down the street, and there's this big, just gaggle of people, and we're like, wow, it must be some sort of celebrity. My kids are like, who's that? Who's that? And I looked up at the billboard, and it was Bruce Springsteen. And then we saw the boss, and he was obviously surrounded by a bunch of security as he was getting into his limo. But yeah, I saw the back of his head. We had no idea. We were just walking.
I went during the Money Show when Greg flew in to New York. I offered my services as a bodyguard to keep the groupies off him. But I guess he got through it okay. Anyway, yeah. Blake, what do you think? Can the dollar fade after this? Break last week and retrace now. Where's your head at?
Well, the dollar. Let's take a quick look at the dollar index. I mean, remember, we still have this big possible double top. But what could be setting up is a bullish wedge. I mean, we still have higher lows. Yeah. We have consistent highs. So, we could have a situation where we're seeing something that looks more like this. Yeah. Where we have this bullish wedge developing. So, even though I have some dollar shorts on, I still, I'm doing it with caution. You got to be still very careful with the dollar at this point, because look, stocks are under pressure. S&P had broken through the 2,800 level. We should get a bounce back toward, if buyers come in the North American session, we should get a bounce back to the breakdown point. Okay. Yeah. And so I would think, maybe a move back to 2,800, 2,805, and then a reversal back down. The S&P right now, though, is breaking lower. So as it breaks lower, naturally the dollar is going to have a bit more of a bid, and that, we're seeing some downside pressure in the Kiwi, but there was a lot of RBNZ comments overnight.
Your dollar chart looks, Blake, the one you had up, the double top and an ascending triangle, that if we break out there and you measure it from the left-hand side of your chart, I've heard objectives as high as 102, and that's what this.
Oh yeah, I mean, if the dollar breaks out, like if it breaks out, you could theoretically do this. Yeah. And then you just take and I'm doing kind of like free-handedly, but that'll take us to 99.5. I mean, roughly, maybe even a little further. So if that breakout occurs, I mean, it could even be further. Yes, you could go, okay, well, maybe from the start of the wedge, that could take us to, what is that, 100 roughly. Yeah. So I mean, and that's entirely possible. Again, this really has more to do with how weak are stocks. Are stocks going to be breaking down? We are in a seasonally
ugly.
It's a period where stocks tend to be a little weaker this time of year. This is sell in May, go away, June gloom, whatever you want to call it. It's just this is the time of year when stocks are typically a little heavier. And so, being that the case, and the go-to currency is the dollar. I mean, if there's risk aversion, the dollar is going to tend to outperform. Now, there's something on my screen. Well, it's not on my screen yet, but it will be on my screen. There's something that I'm looking at that is, it makes me hesitate a little bit as far as being too bearish risk. Now, if you look at the S&P and you go, okay, well, we are, breaking down. The question I'm going to have by the end of the day is, will this end up being a false breakdown? It depends, you know, obviously where stocks end up by the end of the day. But if you look at the Aussie yen, the Aussie yen is holding up very well, and you know, one of the best correlations.
Yeah, risk on, risk off on that one.
Yeah, I mean, you take the S&P, okay, and this is what I want to show you. Here's your S&P 500. You got your S&P 500 that's, you know,
yeah,
as I drew out in the other chart. You got it breaking down, right? The Aussie yen has not broken down, and I'm assuming if you're in European trade and you're like, you know, oh, you know, oh crap, the S&P is breaking down, you know, DAX is moving lower, blah 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 blah. I'm going to short some Aussie yen. Well, if you've been shorting Aussie yen today in European trade, you're not making money. So at this point in time, you've got to be thinking, oh crap, well, how about if, you know, if you look at, and I actually had some statistics a couple of weeks ago, because one of my coworkers in Greenwich, he had put out a piece a couple of weeks ago on the first 2 hours of the day in the S&P. If you just bought and sold the first 2 hours of the S&P every day for like the previous 6 months, I mean, you'd make a killing. What happens is you get these flows that come in right at the beginning as the market opens, and then the market just kind of fades throughout the course of the day. You know, you get some sort of pullback or consolidation or whatever, but all the buying happens in the beginning of the New York session. So the point I'm trying to make here is, if, you know, North American session starts and, you know, buying comes in, what happens to anybody who's short the Aussie yen? Because if you're short the Aussie yen and all of a sudden the S&P does this and it pushes back up, you know, and where it goes from there, who knows? But if it does the Aussie yen, you know, make a move off of these lows? Because if I was short the Aussie yen, I'd be thinking, uh-oh, you know, it's not breaking down. So what do I do now? And so that's something that I think we need to be a little bit aware of. Now, does that mean you should be long Aussie yen? I mean, what I'd like to do, you see this downtrend line, this little triangle resistance. I think that's really, you know, that's the level that if it starts breaking above, here, let me get rid of this. Let me get rid of these drawings really quick in the correlated S&P. Okay, so if we break above, like, you know, let's call it 75.80, 75.90, 76 yen. Yeah, if you're short the Aussie yen, you're going to be like, you know, running for cover. It's still, you know, it's still 30 pips away from here, and the Aussie yen is not, you know, it's not immune from going down. The fact of the matter, though, is it has not gone down with equities, and that is a concern for anybody that's trading this. And then also, if you're short risk, you got to be looking at the Aussie yen going, why is it not going down yet? You know, I was just talking to FX Macro from our office, and we were just talking about the divergence of the Aussie yen and the S&P, and he's like, well, the problem with the Aussie yen is it's not going to go anywhere. It's not going to go very far without any China positive trade news, which is true. I know, you know, if you're looking at the Aussie yen and you're thinking, well, man, maybe this thing's going all the way back to 80, that ain't happening unless there's some sort of positive China-US trade news coming out here within the next, you know, hour. And what's the chances of that happening? Chances of that happening are, you know, slim to none, as the U.S. and China are in middle of not only a trade war, but probably a Cold War on top of that. So, but that doesn't mean that the Aussie yen can't get a bounce and we can't, you know, move back to like 77 yen, or, you know, get some sort of short squeeze, especially if U.S. equities bounce. So that's number one. That's one of the things that I'm paying pretty close attention to. And then also, I mean, you know, we have the Bank of Canada today. Now, the Bank of Canada is expected to keep rates unchanged. The U.S. dollar Canadian is up against resistance. We are having a really tough time at the 135 level. I did short a little dollar Canadian this morning because, you know, as a trader, the one thing that we can control is we can control our risk. So when I look at the dollar Canadian, I know my risk at this point if I short it, right? because if you short it here at above 135, which I happen to be short at 135.05, I know that if we get above 135.25, you know, I'm out there. You know, I can't stay short because then it's a breakout. So let me just draw this out for you guys. So again, you know, as a trader, only thing we can control is our risk. Now, I know that the Bank of Canada, the rate decision's in less than 2 hours, okay? But I also know above there I'm wrong. And from here, if your risk is here, your reward is, you know, obviously somewhere down here. That's a let's say 1 to 4 risk reward. That's fine. I don't mind doing that trade at the moment. Now, the question that you guys are going to ask me is, well, Blake, are you going to stay short the dollar Canadian through the Bank of Canada? The only way I would stay short the US dollar Canadian through the Bank of Canada is if we end up mid-range, which is pretty possible. You know, the dollar Canadian ends up right here, like let's say at 134.70, ahead of the Bank of Canada. Now, if you've never heard me say this before, this is a very important point, is that before a big event, interest rate decisions, jobs reports, currencies tend to go mid-range. Mid-range meaning if you can, you know, visually identify where the range is, and I can look at the dollar Canadian and I can see where the range is. The range is obviously at this point in time, it's right here, right? It's between 135.20 and this 134.20. So mid-range would be, you know, probably right around 134.70. Okay, if we end up at 134.70 in the next hour and a half, I wouldn't mind staying short, because then, you know, I could put my stops at break even. If I get stopped out, I get stopped out. It's no big deal. If we're at current prices, you know, at 135 or 135.10 ahead of the Bank of Canada, I'm not going to stay short, because then I'm not sitting in a profitable position going into the news. I'd want to be in at least a 30 pip profit here going into it, because if I do get stopped out, probably I'll get stopped out at break even. But I'll say it again, ahead of key data releases, currencies tend to go mid-range, because no one wants to be long at extremes, no one wants to be short at extremes, so everybody tends to, you tend to get a moderation in price. So again, I shorted some this morning. That doesn't mean I'm going to stay short going through the Bank of Canada. If you guys are in the ForexAnalytix chat room, if you're part of the ForexAnalytix community, you'll know where I'm at, you know, because I'll be talking about it in the chat room in the next, you know, hour and a half. And that's probably a pretty good segue for me to mention that, guys, if you're not part of the ForexAnalytix community, you should do so, because this Memorial Day sale, we have extended it through Friday, because we had a lot of people said, well, hey, I'm going to be out of town. Can I make my decision next week? We're like, you know what? We're just going to push it up until Friday to be involved with the, you know, with the ForexAnalytix communities. Buy 1 month, get 1 month free, 20% discount on semi-annual, 25% discount on annual subscriptions. You guys, remember, we only do these specials a few times a year, like 3 or 4 times a year, and this is one of those times. So if you've been, you know, you know, on the fence about being part of our community, make sure that you join right now. Okay, so so with that being said, I want to bring on my colleagues here. Well, actually, in just a few moments. I just realized what time it is. I got a few minutes that I want to cover a couple other things. So we were talking about the dollar Canadian. One of the other things I want to mention while talking about the dollar Canadian is crude. So crude is coming into we got a bear flag pattern. We're coming in pretty key support. You see this 618 retracement comes in right here, okay? And crude is obviously under pressure. Now, in order for crude to really start playing out to the downside, we need to break, like sustained break below the, you know, $57 level. I'm happy that crude's coming down. However, personally, however, if crude continues to come down, what's going to happen here is the Canadian could could see some pressure. We might see that dollar Canadian stay back above that 135 level. So the bear flag is trying to play out, but keep in mind that between the Bank of Canada and risk appetite, risk aversion, that's going to have more of an influence on what happens here. So don't get too carried away with short crude just yet, but we do have a bear flag pattern, and we are testing the big key fib at the 618 retracement. So this is going to be pretty critical for crude. See where we end up by the end of the day. If we end up below $57 on crude, and I happen to have a short dollar Canadian and it's working in my favor because of the Bank of Canada, I will close out of the position because I'm not going to fight the crude flows, meaning that if crude oil continues to come down, it's eventually going to have a weakening effect on the dollar Canadian. So even if the dollar Canadian does come down following the Bank of Canada, I'd be very hesitant about holding on to that position if crude is breaking lower. So that's one other caveat that I wanted to mention regarding the Canadian is you got to keep an eye on crude oil as well. Okay, now I want to pass it over to my colleagues. Steve, Stelios, are you guys here?
Nope.
Hello, good morning.
We're not here.
Steve is not here. Stelios is here. Good morning. How you guys doing today?
Good, mate.
Very
How have you been?
Good. Just getting ready for today. I've got, and I didn't mention this to you guys yesterday. I was a little bit of disarray because I woke up late. I didn't set my alarm, and just as I woke up, I have a young man who's sitting next to me. He's learning to trade currencies. His name's Jack, and he's with me today, sitting next to me for the next couple hours, and he's doing that for this week, and then in a couple weeks he's going to come back. It's pretty cool to see such a young man interested in currencies. And he happens to be my youngest son's baseball coach's oldest son. So somebody in the chat room said the things you do to get your son on the baseball team.
Exactly. We know things for sure. One, why your son is playing in the baseball team, and second.
My son's been on the baseball team before his dad joined our team. So there you go.
and second, that this little guy is lucky because he's learning from the best.
Yeah, well, thank you. Well, the thing is, and his mom and dad were mentioning it to me during the baseball season about, my son, he's 17, he's interested in currencies. And I'm like, you should have him come talk to me. There's probably 2 or 3 people in the city that actually are currency people, and I'm like, well, come sit next to me for some time and learn a little bit about what it's really like to trade the currency market. So it's good to have him here. Anyway,
the other one is your neighbor. How is he called? Mihailovich. I mean, it's your friend, right?
What was that?
How is he called? He works for Forex Live. It's your neighbor.
Greg Michalowski. Yeah, he actually lives, and we haven't had a beer. Matter of fact, I got to reach out to Greg because him and I have been on kind of different paths this year, and usually him and I will meet up once every 6 months to go have a beer, and I really need to actually reach out to him. Dale, you had Greg Michalowski on as a guest probably about a year ago, right?
Yeah, I've interviewed Greg quite a few times, and I'll tell you when I was facing some stuff, he was there supporting, making videos. Very good-hearted guy, besides a skilled trader.
He really is one of the nicest one of the nicest guys around. And so, yeah, that reminds me, I'd have to reach out to him and
you better.
A couple of beers. Yeah, I think last time I saw him, I gave him a coffee mug and a T-shirt, and he gave me a Forex Live T-shirt. So. Oh,
do you have the one with Mario Draghi on the front of it?
No, I just have the one that says Forex Live on the.
Yeah, because Adam made those. I'm wearing that right now. Mario Draghi playing an electric guitar.
Nice. All right, guys. Well, hey, you guys have a great one. Good luck today, and thanks everybody. And remember, if you guys haven't joined the ForexAnalytix community, this is the time to do it. I'll catch you guys tomorrow. Have a great remainder of the webinar.
Thank you, mate.
Thanks, buddy.
Thanks.
Bye-bye.
Hey, guys.
Okay. Hey,
Go
Dale.
ahead, guys. Hey.
So Actually, before I start mentioning what's been going on, Dale asked about if we remember the crisis, the 2008 crisis. Well, at the time I remember it very well. I was running the dollar swaps book at Merrill Lynch in London, and just as things started going south, the sterling guy blew up, so I had to run that book too as well. It was a lot of fun, and then shortly after, Merrill Lynch was about to go under. We didn't in the end, thanks to Bank of America. But I tell you what, that last part of 2008 and first 6 months 2009, yeah, I'd rather forget that. So
and you know what you ought to do now, still just pull up the weekly chart, or Steve, and remember how dire it is, and then just look at the break from the high of 08, 7
sorry, you want me
it was nothing
to pull up the weekly chart of what?
S&P.
S&P.
Okay.
Okay. All right. So when you look at that, and you realize what kind of, you'll have to go a little further back. Yeah, there. Okay, look at that decline from 7 to 09, and that was like the end of the world. And right now, if we did something like that, it would be normal, and that could take you back to 2200, a move like that. But you know what I'm saying. Go ahead.
If you're talking in percentage terms,
okay,
it would be a lot lower than what you're saying.
Okay, I'm just saying, you look at that break.
Don't forget that the S&P went from almost 1600,
50%
at the peak, to 667, if I remember right.
70%.
So imagine if we did something like that, today. I mean, it would be, a deeper pullback. Then
what, 1500 or 1400 or something?
Actually, less than that. Yeah, less than that. But
okay.
From a technical,
the main point that Dale is making is that you look at the decline, then you look at the rise from the ashes, right? So,
and 2002. I'm just saying the magnitude. Percentage terms, but the magnitude after what we've had here, it doesn't look like it could have been the end of the world. Just looks like a pullback. But what was happening on the ground was so much more serious than the way the chart looks when you look at it through a telescope.
Absolutely, that's very true. And one of the reasons is because with monetary policy and the distortions we have in the market increasing by the year, Wall Street depicts less and less what is happening to the real economy, unfortunately.
And it's 150% of GDP now, right, Steve? So what was it back then in like 07, like 40, 50% of GDP?
No, actually it was more, but yet still, I mean, we picked, I think, but I might be wrong at that. We picked at something less than 100%, but still, now it's a lot more within a few years, right?
Yeah.
A lot more. And
amazing.
At that high, once again, we had a record as a percentage of GDP in comparison to what was happening in 1999, 2000, et cetera, et cetera. So you get the point. I mean, we know that this is the third business cycle, in essence, that monetary policy is influencing, so much, so outright, so profoundly, if I may say.
Yeah. And look at that, it's a 3 drive.
Yeah, you have a point there. You see one everywhere, but yeah.
I do. Even when I'm on the freeway, I go, there's 1, 2, 3. 3
I have to take the third exit.
All right, buddy. Thank you, guys.
So, what did you have today?
Not that much. We had the RBNZ. Governor Orr was speaking overnight. He said that the rate cut is still working its way through, kind of quite neutral overall. So, the Kiwi is only marginally down, but that's because the dollar is strengthening slightly across the board. We also had China threatening to withhold rare earth metal sales, and that is obviously aimed at giving them leverage in the trade talks. So,
of course.
Like we've said before, they're not going to just slide down and take whatever the US is throwing at them. The funny quote of the day was US Secretary of State, I can't say it without laughing, Pompeo said that the US may or may not get a trade deal with China. I wonder if there's a third option. Yeah, and you know, you have to admit we do laugh a little bit, you know, with these things. But the other
he's the recent Pythia, you know. Yeah. Στο πόλεμο θα πας, δεν θα γυρίσεις. Depends on where you put the comma. It means that you come or you won't come back.
So in terms of data, we had a couple of things. Okay, we don't cover Swedish krona, but it's good to look at what it's doing. And we had a GDP reading, which was quite a bit stronger than expected, 0.6 versus 0.2. And also the actually quite startling number that came out this morning was German unemployment. If anybody looks at the chart of the last, I posted it on chat room.
It's 5%. It's 5% now, right? It increased slightly to 5%, correct?
Yes, but if you look at the unemployment change in terms of actual numbers, not percentages, you know, how many thousands of people, the chart of the last, 5 years, you have monthly prints of, plus or minus 10,000, and they're all negative. So unemployment was dropping, and this print was positive 60,000, and we were expecting a slight negative number. So it stuck out like a sore thumb in the chart. Yeah, there you go.
Here it is, by the way, Stelio.
Yeah, there must be a reason for it, but it didn't look good, that's for sure.
Yeah, usually a big outlier on its own doesn't mean much. But
yes.
If we see something like that happening, next month, then you need to start wondering, if there is something big that's happening here.
Yes.
I won't pay so much attention to a single outlier, though. But yeah, it is something that will give more importance to what happens next month for sure. To monitor what's happening during the next 2-3 months.
And I think the market agrees with you because the euro barely moved when that happened. So,
I think I think we need to give it a little bit more time to see if this is the beginning of something different or not.
Correct.
One thing is for sure, as I was saying the other day, unemployment is always very low when a recession starts, and the opposite. When expansion starts, unemployment always starts at very high reading. So having very low employment doesn't mean that things are good, and the opposite. Regardless, we need to see more evidence. We've already seen several indicators weakening from the side of the European Union and especially Germany. Let's see if employment data is going to be included in that.
Yes, it hasn't so far. It hasn't. That's the thing.
So employment
all around, employment has been good. In most economies.
Yes. Although as it has been happening with, during the past couple of decades, quality of employment unfortunately keeps dropping. But this is not a new trend. It's quite established now.
Yes.
Okay.
So that's all I had. I have to remind you just before I forget. At some point, if you can have a look at USD NOK, because one of our friends in the chat room has been asking for it. You have it. Okay. But that's it for me.
I actually talked yesterday extensively about it, saying that 880, 882 has been a very resilient resistance area, but there is no reason to expect that USD NOK is going to move to the downside as long as it's holding within this ascending channel, as long as it has broken above this multi-year corrective move, and as long as crude remains under pressure. So playing it short from 880, as I advised last week, that it's a good risk-reward opportunity, I think has possibly limited downside, because 860 should be considered strong support. And if we go back to crude, which is exactly what I did yesterday, but crude has moved since yesterday, so it's worth seeing it. As you see, crude is now actually threatening with a break below this 58 zone, because it's a zone, it's not as like a single level. It's no surprise whatsoever, because if we go down to the 4-hour chart, you're going to see that, simply put, this was a textbook bear flag. Okay, so it looks to me like crude wants to run towards the next objective, which is, above 55. And, USD NOK is going to find it very, very hard to resist breaking above 880, 882, as long as, first of all, crude remains under pressure, and as long as the dollar remains well bid. As we were saying yesterday, and I'm going to reiterate once again, there is the possibility that the dollar index is trying to put here a double top in place, but you have absolutely no reason to want to trade that until you get confirmation. And what would consist of let's say the minimum confirmation here, in my opinion, breaking below this ascending purple trend line support. As you see, it has defined the uptrend that we have in place since February 2018. So it's like already a 15-month trend, which more or less confluences at the moment with this previous low here at 97.03. So a break below that level, first of all, would put in place a lower low, which we haven't seen in some time, and at the same time break below this ascending trend line support. That would be for me a very, very strong warning signal. And then I would be watching for this blue ascending channel as well. A break below that as well probably is going to put the nail in the coffin of the dollar. I think that long positions are going to start crumbling if that happens, and people are going to start running for the exits, and that will likely produce some acceleration lower for the dollar index. Until that happens, I see two alternatives here. One, I'm talking about myself. Everybody makes their own decisions, of course, right? One, remaining neutral and waiting, and two, being bullish, because let's face it, there is an obvious upside momentum loss, but there is absolutely no technical event that says that the dollar is still not bullish. And actually, as Blake said before, if we actually break above this area, we might even see it accelerate to the upside. I mean, the market, might be caught by surprise if that happens. So personally, I'm just, remaining, neutral, and I'd rather wait for some confirmation before I do something. At the same time, you can see, the most popular dollar pairs like the Fiber, Euro USD, trading still near the lows. I think that it's not going to be a surprise if we see another push to the downside, breaking below 111, 111.10. That would probably get a lot of people sorting, perhaps at a very bad, with a very bad timing, because if then we see a reversal, which I don't consider unlikely. I mean, it looks to me like the dollar doesn't have much more momentum pushing it higher. So I wouldn't be surprised if we see one more flush higher for the dollar, lower for the Euro USD before higher. For example, as you see, we have this descending trend line support currently passes from 110. Equivalently, you can see here the cable looks very bearish to me here. But we've had a consolidation that can easily be a wave 4, because I do see a 1, 2, 3. This is likely 4. So two things here, as you see, we drew that like some days ago. First of all, I think it's extremely likely that we're going to see another push to the downside, but I do think that we might get. It's likely that we're going to get like a stronger pullback after that towards 120. 128, 128. 65, whatever that is, that previous low. But until that happens, as I said before, you need to respect the fact that the dollar remains strong. USD Swiss, not much different here. You see this pullback that we've had in the dollar a little bit stronger here. Why? Because at the same time we've had some risk off, and that risk off helped the Swiss franc strengthen, and that helped USD Swiss depreciate somewhat. But keep in mind that USD Swiss is still trading within this long-term ascending wedge. You can see we have a strong confluence of supports roughly at 99.50. You see the 200 daily moving average 78.6 of that last move higher. Even this ascending trend line converging there. So I do think that USD Swiss is a pair that will probably produce in the near future a nice trade, because I do think that either we get a break to the upside or to the downside. Probably that should build some momentum, and a lot of stop losses will be triggered. A lot of people will want to participate. But until that happens, really, I don't think that you should be pushing your luck here. If you want to be trading the range, that's a totally different story. But for me, this is also another one to wait for it instead of doing something. Now, if you remember yesterday, speaking about risk, that we were talking about the Swiss franc, I was saying that for me, the likeliest scenario here is that we're going to see a breakdown from this little triangle and another push to the downside. Ideally, I would want to see this 38.2% fib, which also coincides with this low and the beginning of this ascending wedge, actually, being tested. We have to take into account, though, that there is another area of support between these two, and that's the 200 daily moving average, which, as you see, currently passes from 27.73, 74. So, this is the first area of support, and then 27.20. I'm still holding 2/3 of my short. 27.20, I can actually, pick up some profits there. It was a tough ride here in the S&P, but as I said, it's not far away for it to be a profitable trade. So let's see how that's going to work out. It looks good, though, for at least one more push to the downside. Even if that proves to be corrective, 27.20, as I said, is easily doable. Now, if we want to have a look at the rest of the indices, you can see that, first of all, we have one event here. DAX is breaking below this ascending channel. Keep in mind that this is a channel that the index has been respecting since the very first days of December 2018, which means that this is actually almost a 7-month-old channel. So this is a technical event. I would love to take advantage of it and short it. What stops me from doing so is the fact that, as I've said multiple times, 11,800 is a very, very strong support resistance area, has proved to be so multiple times in the recent past, and a breakdown below this channel wasn't far away from that area. So I'm remaining skeptical, but if we do break below 11,800, then I'm going to have two events to consider, which is breaking below the channel, breaking below this 11,800 area, and it's very, very likely that I'm actually going to be shorting some DAX, if that happens. FTSE has broken below its equivalent channel, some time ago. 7,100 has acted multiple times as support resistance in the past, is the closest area of support. And one more here, it's the Nikkei, quite a nice impulsive move to the downside, in my opinion. And this is what we envisioned back here when we were breaking higher. I said one more push higher and then a breakdown. So far, this has worked out. Now, what's been happening here in the short term? Let's clean up a little bit the analysis here. So this all has happened. So what is happening here? In my opinion, it's the same thing more or less that's happening with the S&P. We saw an impulsive move lower. In my opinion, what we're seeing now is a consolidation before one more, at least, I should add, one more push to the downside. So, saying this about the USD, and by the way, if you look at the RSI is also telling me the same thing. I mean, a nice rebound from oversold territory roughly to 45. It's exactly what you expect to see from a market that wants to move lower. So, having said that, if we have a look at the USD yen and its recent consolidation, actually, it's even better worth looking at the USD yen on the 4-hour chart. There it is. You'll see that, first of all, we broke down below this channel. If you remember, I expected this, that this should prove to be corrective. And most likely, this is another consolidation that is probably going to break the downside as well. So that's my point of view about these markets. S&P is very close to 200 EMA. Yeah, Stan, yeah, I just said that. You say it can hold. Yes, it can. Ideally, that's what I said before. Probably you wrote your comment before I said it, because I just had a look at the messages. It can hold it, but personally, for technical reasons, as I said, I would prefer to see a move down to 2720. By the way, speaking of which, there is one thing missing here. Let's see if we have another conference here. Let's FIB extend this first leg of the move lower. There you go. First leg of the move lower with another one. That targets 2731. So, another thing pointing at lower levels. So I would want to see a move towards there, 2720, 2730. I think I'm going to be relatively satisfied with that. I'm probably going to close my position unless the move towards that area happens, in a way that shows that the index is breaking down, in which case I won't want to take, profits there. I will want to, hold for longer. So it depends on what kind of structure we have on the way down if we make it there. If for some reason, the index accelerates its losses, towards that area, let's say we make it there in a couple of days, then it's going to be a totally different kind of thing to consider. And I think we can be talking then about like a third wave down, which is going to be showing at the very least of a much deeper correction than the one we're envisioning at the moment. Okay. Could be inverted head and shoulders in the DXY. We have a comment from Mer. Let's have a look at the DXY on the daily to begin with, and let's see what you're talking about. Don't see something like that on the daily. Let's see on the 4-hour chart. Yeah. First of all, I'd rather not try to find inverted head and shoulders formation in uptrends. Second of all, I see what you mean, but it's not even that well formed or whatever. So no, I wouldn't be looking at it that way. That doesn't mean that it's not still possible to move higher. As I said, we have to respect the fact that we remain in an uptrend, but I wouldn't want to interpret this as an inverted head and shoulders. Okay. So let's see what else we have. Yeah. Speaking of which, let's have a look at the Aussie yen. Aussie yen looks to me exactly like what S&P was looking like yesterday. I have to admit what Blake said, that it's still holding. But I still don't see anything more than a bearish consolidation here. So, I want to see a lot more to be convinced that this is not breaking lower. Now, on the other hand, Kiwi yen has a possible interpretation that is bullish, but in order for me to even consider that, I want to say break above there, 72.23. So, having a look at most risk correlated assets, I would have to say that the vast majority of those look in danger of continuing lower, and those of them that could turn bullish, I think they need to move somewhat, before we can say that. Gold and silver, by the way, since we have a question, nothing really happening here. Silver is toying around with this 78.6% fib on the precipice of breaking down to retest 1390. So nothing has changed really here. And gold, on the other hand, still consolidating within this, this triangle. You can, call it whatever you want. It's not a pennant because it's already too prolonged. But, as I said yesterday, 1265 is, important support. If we break below 1265, I think that's going to be a very bearish development, and we should extend lower. On the other hand, I'm watching this descending trend line resistance as possible resistance, but in any case, 1300, this previous high, is important. A move above 1300 should also help it accelerate to the upside. In between those two areas, I would personally not be doing anything. So in between 1265 and 1300, in my opinion, it's, you better leave it alone. Yesterday, I was mentioning here that copper remains bearish as long as we, stay below this horizontal support resistance area. You can see that we're accelerating lower once again. Still looks, quite bearish to me. Another risk correlated asset. And I really don't see any serious area of support until we make it back down to this horizontal support area at 257. So nothing to add here. Platinum also remains bearish, 778 next downside target, and palladium still, chopping around, not doing much. Now, on the other hand, benchmark bonds are actually accelerating to the upside. Another signal that risk is not healthy. So we saw that yesterday. Treasuries have now broken above the confluence of the 78.6% fib and the 127% extension of this move lower. At least it's trying to. We haven't closed the day, to be fair. And the next upside resistance is the 161.8% extension at 126.13. Same deal with the bond. If you remember, I was very clear. Bond remains bullish as long as we remain, above this horizontal support resistance area. Next stop at 168.41. That's the all-time high. We actually came quite close to that today. We made it almost to 168.10. So, there's no question about it. The bond remains very well bid with whatever that means for risk, as I said. If we also have a look at the yields, here they are, 10-year treasury yields. As you see, approaching 2.2%. We are now comfortably 1% lower than this double top that we formed in November. Okay, everybody thought back then that yields are moving higher, but the market has the tendency to, be quite cruel with, market participants when they tend to agree too much on something. And, that was the case once again here. So next area of support, the 161.8% extension of this rebound, which would imply yields coming down to 2.175. Okay, so nothing really pointing to a reversal in all of those instruments that we just had a look at. What are your expectations for crude? Probably you came in a little bit late, as I was saying about crude. Crude seems to be breaking down below this 58 zone. And if that gets confirmed, I think that the next target is almost down at $55. So, quite a lot lower from where we currently stand. Coach is our guest.
Yes,
here today.
John is here.
Okay, perfect. We are at the top of the hour. I think I covered, most of the things.
Not the Zlotny, the Polish Zlotny.
Oh, yeah, sorry. I promise I'm going to do that tomorrow.
The shekel Zlotny spread so I could buy kielbasa and pierogies. All right. Anyway, thank you, Steve.
My pleasure.
All right.
Enjoy the interview.
Thank you, my friend. John Davies. Really looking forward to talking to you again, my trading warrior brother. Making you the presenter. Looking forward to hearing your voice. Not sure if you're going to be screen sharing with us today. John, how are you? Welcome to Face.
Thank you very much, Dale. It's a pleasure to have a chance to speak with you and your listeners today. I really do appreciate this opportunity. And,
thank you, John.
It's
when was the last time you and I had a conversation?
Well, the best conversation we had. It was kind of funny because it was just before Christmas, and I was in New York, and just as we were talking online. As you remember, the dogs began barking, and then someone started to do some repair. So we had saws going off and dogs barking. So I was all ready to talk to you, and I had everything all set up, and then just all of a sudden,
who let the dogs out?
That's right. Christmas in New York. But
all right, John. So you're not going to be screen sharing, so I'm going to be flipping around on different markets.
You've got some great, and first of all, I want to thank you for having me on your show, and listeners, you have a tremendous show. I was just loving Steve's discussion beforehand, and I hope to add some. I hope I can interject some value and some long-term considerations to investors, because I think that's one of the things that's missing in today's market often. Right.
Yeah. So immediate gratification is what people are looking for. They're in the trees. They're not looking at the forest. In fact, they're so micro, they're picking off the leaves of the trees.
You know what?
Every 10 minutes.
Brilliant idea. I mean, we went from an investment community when you and I were young men.
I don't remember.
That's another sign. That focused on long-term asset development, wealth accumulation, and wealth protection, to really an era of flipping. So much that many investors no longer have a position because they're constantly flipping out of position. And certainly, if you're in the futures world, that's obviously it's a completely different game. But for the vast majority that are involved in equities, they're often, I think it's because they're no longer considering fundamentals, no longer considering the long term, and they're looking for such short little hits. They're missing the big long-term appreciation. Right?
Okay, so I just posted. I'm showing the weekly S&P chart here, John, and we had this tremendous rally from late last year when your dogs were barking to the recent highs up here. And go ahead.
Yeah, it was it was almost a very transparent and predictable rally, I believe.
Yeah, it was strictly jawboning by the Fed backing off and sitting and holding hands with Bernanke and Yellen, all three of them.
Without question. And so for investors, at that time, we were talking about things like FCX, tech, in situations, and really it applied to everything. For typical equity investors, and this includes your American investors who are in 401ks that allow options, why don't we look at these situations and we can see very, very telegraphed, what I call telegraphed, I guess that's even a term that not even people know today, telegraphed movements, to use it to write calls and to purchase some at that time, into rallies, relatively inexpensive downside protection. And I think the biggest problem that we have today is not only is that we are so much focused on technical analysis, which I certainly agree with, but we're not spending enough time on fundamental analysis and spending near no time on risk management. And risk management should be the priority of your standard retail investor. And it was one of the first things a professional in the brokerage industry, 35 years ago would talk about. We're going to protect your money and create an opportunity for it to grow.
Right. So the interview is really becoming crystallized to me since you brought up Freeport, and I remember it, and you liked it down here.
Yeah,
and
no,
you had a combination of being long the stocks, and your strategy is to have sold enough premium to
that's
where it
right.
was kind of riskless, and that was a great trade. I mean, you had
And
a 25-30% rally.
Yeah, and
How,
the greatest.
how did you know when to exit it, John? Because here
Well,
we are revisiting it.
That's really, it really comes down to disciplined trading. In other words, when you make, I tell people, look, my goal is to eliminate the cost of investment in one shape or form, typically through the writing of calls, or maybe if you're acquiring through writing of out of the money puts and then later on writing calls, right?
Mm-hmm.
My goal is to reduce the cost of the investment completely within 30 months. And that kind of, for an investor today, when you say 30 months and eliminating the cost, that doesn't seem too exciting to them because they haven't done the math. And what we're saying is we're getting a 40% rate of return. Now, when you can be taking yourself home approximately 0.8% of the stock value in premium per week, it's not too hard for us to do a little bit of math and saying we're getting over 40% rate of return for basically a rental agreement. So there comes a time where you have to, and this is all an individual investor. And when I press that amount of saying, okay, I'm getting 40% ROI here. And now I'm then looking at the chart and saying, well, your FCX. And once we jumped in at FCX and we looked at it, and we got our cost at below $10, and we quickly brought it well below, 8.5. And then it starts pushing to that $13 mark. It's time to get out and say.
So you took it here?
Yeah, and that's where we said, okay, that was a nice place to exit. We did the same thing with a company that's a little bit less traded in the United States, Hudbay Minerals, and Hudbay Minerals was the same thing. In Q4 earlier, we suggested purchasing it.
What's the symbol, John? What's the symbol?
HBM. HBM.
Got it.
And HBM is, again, it's mostly a Canadian company and mostly known in Canada. But it's a beautiful little mining company, particularly when it's
depressed.
Yeah, and when it's a distressed price.
Yeah. Aren't all the miners?
Well, they are, because again, investors of 2019 aren't so interested in commodities. And Dale, my history basically comes from the commodity sector. But what I quickly realized as a long-term investor that using equities and using this theory is a much easier way for long-term portfolio or approach to portfolio management, more proactive. Well, here's my, and you've got so many great people on your show. I could listen to the prior Steve any time, every day, and yes,
we won't even charge you.
There you go. and when you listen to it, one of the things that you have seen now in the investment community is a lack of interest in commodity bases and commodities. The investor himself, the retail investor.
Yeah.
And this is, it's interesting because you've got many firms now suggesting there's going to be a great commodity bull market, and I'm certainly in agreement with it. And
is it going to take a turn in the dollar for that to happen, John?
Well, that's when it takes a mighty whipsaw. Now, I think what we're going to have is we're going to have strength in the commodities, but before then we're going to have weakness. In other words, as Stevio suggested, I'm in complete agreement that crude has been breaking down. That's where my focus has been watching for the last little while. You can watch just crude just shake down, and I think we've got a $55, a 55 coming, right? But within that, then we've got all those opportunities within the big names. The big names in the
I know some guys, John, that are looking for the January lows to be violated. Can you see that happening?
Well, see it happening. I'm not positive. I will definitely have my position.
Well, you never could be.
Yeah, exactly. Could it absolutely look? This is a period. This is one of the great period of investments for savvy investors, in my opinion, because we've got such extreme volatility. You know, you've got the head bay chart up, and if you look at it, this thing was hideous just around when we were talking. It was around just under 450 just before Christmas, and we watched that rally above 7. And I was very vocal on this because it really is an equity that should be at some time around 7 or 8, right? In the above 7. But of course, it has this big whipsaw, and it tends to get oversold. Well, and of course there's some backdrop to this with board situation, but it took that run just last month above considerably above $7, where it's time to say goodbye and say we'll visit again. Well,
are any rare earth minerals in this mining company?
You know what? The big play with Hudbay Minerals is really as a base metals. This is
copper.
In many ways,
so it's a proxy for copper.
It is a very good proxy for copper, but it also tends to, because of its the way it's traded, let's say, it tends to oversell. It tends to really be highly dramatic, we'll call. But you've got great proxies with FCX. I mean, that's obviously FCX is the beast, right? Yeah, and a great one for you to look at Bitcoin here. But so you get these situations. Well, this is just a standard situation. You make money as an investor on the buy side. That should be the most obvious thing, but sometimes we forget the obvious things. So now we want to be buying these situations cheap. Well, we get these great sell-offs. Now, when we get these sell-offs, like for instance, what I'm doing right now with something like FCX, because I believe so much in Freeport, right? I mean, it has a company with tremendous long-term value, and if you believe in the return of infrastructure, now we could see a shakedown. I think there's going to be a shakedown where copper could even test the 245 mark, right? That's something we have to consider, because this is a very uncomfortable month or two, right?
Because of the trade war, or because of seasonality?
Well, the big thing is trade war. We've got a G20 meeting where the investment world, G20 at the end of the next month, the investment world is going to be watching everything like a hawk, right? And watching various things. So it tends to be overly dramatic, and it really is hurting. It's hitting commodities straight in the face, right? So when Freeport went below 980.85 earlier last week, we were selling out of the money puts. I want to acquire it cheaper, right? That's my
What
goal.
strike are you selling?
Well, I would look at cascading. I love getting in the 9s and 8s, like low 9 and 8s. So when I say a cascading, again, you go when you're logging in, when you're rolling into a position. Let's just say, for math's sake, you're going to buy 800 shares. That's just we might look at incremental purchases at 1/8 marks. So you might roll into be long 200. Write 2 calls, then write 2 puts at a certain price, right, the lower, and then write another 4 puts at an even lower price. So what you've done is you've went out and said, I'm looking to acquire in 8 units at the stock at a certain price, but you're gradually lowering your price. So assume if the stock actually lowers itself, although you don't really anticipate that, but you're paying for part of the investment. So it makes it kind of a very simple tactical play for you, right? So it's easy in that regard. So with these, you're always, when you start on your accumulation, you start in a buy right, and you're putting yourself always in a positive situation, a positive trade. In other words, you're always winning in it, but your goal isn't necessarily to acquire and watch it run today as much as you would like that. Your goal is to write down the cost of the investment. Now, that works even greater, or I should say even greater, that works even more easier to illustrate with people who buy stocks that have a dividend, are income investor. And given the fact that such a high percentage of our population is in or nearing retirement age, where they're going to be looking for income in their investment portfolio, I really hope, and I'll do my best to do this personally, is that we can teach a generation of mature investors how to use options to increase their return on investment on a monthly and quarterly basis, as well as provide considerable downside protection. So in other words, not only, they're not simply hoping for that or planning for that, 5 to 8% dividend yield, but they're doubling and trebling that ROI, and also with a level of comfort, right?
How do you do that, John? Because I don't see a website. Do you just have? How are you mentoring people, and just from people you find on Twitter?
Right. That's right. I'm just mentoring, and I'm not trying to promote any service that I offer. To be quite honest, I enjoy helping the investment community. I do help investors on that, but I'm not using my Twitter feed or website or online presence to promote in that. I'm helping where I can. I do have private investor meetings and things like that, and working with hedging groups and hedge funds on just a private basis. But within the online community, as much as I could do to help, I will. And I don't want to make that into a business. A fee for service, because this is something that, Dale, and our youth, this is something that the investment community, certainly the ones that I was involved with, helped teach a generation. This is the classes that I taught in the, in the early 1980s on how to help people learn to hedge funds better, hedge their investments, make extra money, and build a future. So I'd rather give this away than try to sell it with something, because besides, there are some people that offer tremendous services, that I just want to be a part of helping, right?
Okay, well, do you think a part of helping is that we've had a prolific bull market? I was talking about the weekly in the S&Ps for with Steve and Stelios, and it's become more of a two-sided market here since the last year or so. And when I look at the S&Ps, we've been here before. We're right at major support, but when you look at this, and in fact, let's bring up a monthly, John, because I want your impression. So, okay, this was the Great Recession. Was it great for you? I ask people that all the time. All right. Anyway, the Great Recession, right? So this was, a 70% loss of value. Now, I'm not saying that's going to happen, but, I can make a case for 2,200. So do you have to shift your strategies? And, eventually, who knows when, 2022, 24, this prolific bull market brought on by central planning could end and correct 50% of this advance from the lows in. So do you have to change your strategy from looking for things to buy and write calls? Well, to looking for things to short and write puts?
Yeah, see, one of the things that I am always, going back, it sounds like, I'm doing an ad for Wall Street Weekly, but I always believe Louis Ruggiser's comment of flight to quality. In other words, always look for quality. Yeah, well, and if you're looking at
even in stocks, so like blue chips,
things that you believe in, but also I'm also strongly commodity based. But I also, as far as I believe in, those tangible assets that people believe in, invariably that goes into energy, and related into the mining sector. There might be a few differences, a few variations from here to there, but that's in basics where I typically go to. Now, I believe at all times a person should be hedged always. So, and it will vary from individual to individual. These past 3 weeks, I write calls on a weekly basis. I've been writing more in the money calls. So I'm basically stripping out the option. I'm stripping out the premium theta. We can talk about that, the time value on those options each week, so that I've got a lot of downside protection on that. Now, last week I entered into a situation where I started to go long into FCX and tech. Had a little bounce, and I also initiated the start, which would be a long calendar spreads. But that was just the start of it, and with those, I will start to write off the cost of the investment over a many period of time. Really, it's going to stretch into the new year on that. But my belief that they are at or near within 10% of their base. Now, within the index, I believe every investor of some level, but certainly if they're able to invest in equities, I guess you could say that they're at that level, should be looking at some sort of indice put, long indice put, that downside protection. Whether or not
people have been saying that's a waste of money, like fire insurance on your house is a waste of money.
That's exactly it. You lock your, if you're like me, you lock your doors at night, when your children were little because you're terrified of anything. So why wouldn't you protect your money? Now the same thing goes with your,
you know what, John? You just reminded me of something. Have you ever heard this? What good is happiness? It can't buy you money. Anyway, you're a mining guy. You're a mining guy. So I'm putting up this gold silver ratio chart, John, because I think we're peaking.
Oh, okay, I believe you're absolutely right. And
all right, so here's the long term, right? We're back at the highs that we had in 08 before it really came in, and this was the Fed, right? So silver outperformed gold here, gold's outperforming silver here, and I think we're getting close to a turn. Do you think that, I think the mean or over time, in my career, I was kind of used to seeing it in this range, around 40 or so. Is that what you've noticed too?
Without question, it's percolating. One of the great interviews you had on not so long ago was David Brady, and and it was just fabulous. David's brilliant, and one of the things to me it looks like, for lack of better terms, gold is percolating. In other words, you get that positioning, the weakness, and you can see it rip, and it's going to rip after we get one more pullback of the S&P, and it could be a profound one. I'm hoping it's not for just simply the retail investors and our 401k people, right? And that's just my hope. But we're going to get that, and then we're going to see the Fed make its move, and we're going to see then gold profoundly, right?
Okay, I have an expression about hope too. I'm like Jimmy Durante. I have a million of them. Hope is the oxygen in our life, but the carbon monoxide in our investing.
That's another good one. I like that.
So, when do you? So the risk management side is basically where you're, say you're long a stock, you're writing calls. Your risk management is there. Say Freeport went to 7. What do you do?
Well, I mean, for that situation, with Freeport going to 7, that's when you're 8. At that stage, you're looking at, full collapse, and the equity, because you're looking at a significant, or not full collapse, but you're well past your panic point. And that is because that's one of the reasons why I like using weekly options. Now, once weekly options, you're able to make a bigger adjust quickly. You obviously have a greater theta, meaning the time evaporates quicker. I think I explained that correctly. When the options expire, we're able to constantly adjust. Now, if it's any clue, in the last 3-week period, I have been writing in the money calls. So I'm chopping out what I can. I'm chopping out that small ROI, which is basically 0.5 to 0.75 of the equity price per week. That still is considerable, right? When you look at it, but it gives me that greater comfort zone, right?
Yeah. Okay.
Now,
so
for investors, but the whole thing that I really want to impress upon investors on this, most important thing, in my opinion, is that they look at these situations going, I'm not going into positions naked. I've got some downside protection. And if we can this is such an extraordinary period for investors because we can protect our downside like no other period more easier in history. And whatever, but just don't go into these situations blind and without a long game perspective, right? Now, with all of these situations, we're going to see the one thing we can count on. If you're an investor in commodities, one thing I believe you're going to be able to count on now is a lot of whipsawing. Crude is we're looking like we're breaking down. We're going to possibly test that 55. You can see it. And then there's all sorts of fundamentals that suggest you could see, the 70s rip hard, right? And the same thing with copper. Copper is definitely going to test some lows and hopefully affirm its support level. But the fundamental side of copper, there isn't going to be another copper mine in serious production under the $3 mark, and we're already in a significant supply deficit, right?
Okay. All right. Well, I tell you what, John, is there anything you wanted to wrap it with? And I know the best way for people to follow you, and I recommend that people follow you at Renegade Style. Why don't you just tell me what was behind the handle? You consider yourself a maverick, a renegade?
Yeah, you know what? That's always been my modus operandi. A contrarian, someone who did things completely different. And I think one of the things that I want to tell people, I hope that they can look at people, certainly the options group in Chicago do the best job in the industry. But I always tell people, in 36 years, I've been able to figure out markets go down each week or markets go up, but no one can predict that. But each week, option premium decays. And that is your great gift for the retail investor to take advantage of that marketplace, write down your cost of investment, because none of us can come up with a yield of investment that costs zero. In other words, it's infinite. And we can all have very safe, comfortable portfolios and eliminate risk and enjoy the benefits.
Great way to wrap it, my trading warrior brother.
Thank you very much.
Markets go up, markets go down, options always decay. Love it. So, John, really great talking to you again, and
thank you very much.
Much success between our next conversation. And
I look forward to listening to you shortly.
Yeah, may every option you write turn to dust.
Thank you very much. There we go.
I bought a few. I've seen it, so it happens. So, thank you, John Davies, everybody. Follow John at Renegade Style on Twitter and learn how to be the house. So the house sells the option that all the retail guys come in and buy. So that's a wrap for us today. Remember, don't just count your pips, count your blessings. You're welcome, Tom. Tom enjoyed you, John, and so did Alina. And thank you for edifying faith today, John. And really appreciate your time. Because,
thank you very much, sir.
All right, buddy. So that's a wrap, everyone. See you, Glenn. See everyone. And remember, I know where your stops are. Dale Pinkert at Forex Stop Hunter. And you know what? Sometimes people know where mine are too. So have a great rest of the session. Don't forget to take advantage of the Memorial Day sale. And we'll see everyone tomorrow. I have Anthony Crudelli on. Anthony also hosts and talks to a lot of great people. He learned the business on the floor. So I'll see everyone tomorrow. Enjoy. Adios. See you, John.
Thank you.